market's really screwed up. And I don't agree with them. For us here at Phil's Gang, we make it so it's simple. It doesn't matter if the market's bad or good. We consistently do well because we make it simple. And just like for my listeners on the radio or on the internet or my podcast, we make it simple. We try to break it down so you really understand why the market is going up or why there's continued inflation or why the bank rates are going up. So you understand, especially yields. The most important thing is to understand how yields work. Just what we do. We work hard at it.
Trusted advice, easy to understand strategies that will make you a better investor. Get all the details at philsgang.com. That's philsgang.com.
Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
And welcome to my podcast. Okay, interesting today. So, we had the Dow go up 590 points. And by the way, thank you for your service. Appreciate all of you folks who were in the service like I was. I just don't think they celebrate this day the way they should. But anyway, that's for another discussion, another day. But anyways, thank you for your service. Okay, so going back and taking a look at what's going on here, as we came in this morning, I told my gang members, look, I don't know why they keep the stock market open when you have the bond market closed, because the bond market is like a map. It's like a road map, tells you where you're going. When they take that road map, you're out there floundering around. So today the market goes up, the Dow 500 points, only a few stocks went up, and I'm going to go over that with you. And yesterday we had the FOMOs. Those are the tourist investors that don't know what they're doing. The FOMOs are those investors who are gamblers, fear of missing out. They keep on, they keep going to their margin accounts and keep on borrowing and borrowing because they just don't want to miss out. And yesterday they thought, we buy on all these dips, get all these tech stocks. And you can see today they got really hit hard because they rotated out of tech stocks, other investors, leaving the FOMOs losing money, and they went into value stocks. Now, just before I begin, so I can clear this up for you, if you go through the Dow, it says there's, and it's something you should do. When you see like the Dow's up 531, 591, you should go through the Dow 30 quickly. It only takes a couple of minutes, not even that, and see which stocks have the action. And then you can put it in perspective. So Amgen today and Coke were really the two leaders. They were the two leaders out of Honeywell, Johnson & Johnson, and McDonald's. Those were the ones that moved the market, okay? So Amgen was a good pattern to it, had a good volume, had a good, what we call sweet spot, buy signal. And Coke, another one, had a beautiful buy signal, beautiful sweet spot, buy signals, good volume, but that was it. Now, there was a total of 5, so let's go look at Honeywell. Now, Honeywell went up, and Honeywell today, everybody jumped in, but they're going to lose money. Because one, it's under all 3 moving averages, number one, you don't do that. And 2, if you look at, there's no sweet spot in this stock. You look at the stochastics, they're buried under, and again, you're buried, Honeywell buried under all kinds of sellers. They're still sitting there selling, which means you got to fight your way up through all these sellers. Why do that when you can go buy a stock that's breaking out, making a new high? But anyways, the point I'm making is, so I wiped that one out, okay? Johnson & Johnson, which is one of our stocks we trade all the time. Now, Johnson & Johnson looks good. It doesn't have the sweet spot I want, where the momentum is. Still on a little bit of a downtrend, but it's okay. I can watch that for a couple of days, but it's not the quality of Amgen and Coke. In other words, when there's a rotation, you got to look at the patterns and then go scope them down, and you're looking out for a certain pattern during a rotation. Because much of a rotation, also remember, is short covering. Where people shorted the stock, they're just buying the same people who shorted, just buying their own stock back, pushing it up. So you have to scope down the stock to take a look at the, as I call the sweet spot, the setup. And if it's not there, but the stock went up, it's not going to do you any good. It's all going to come back on you. It's going to claw its way back down. So that's what's going on. So really, I would say today you got just two stocks that should take credit for this rally in the Dow today, okay? And let me see. And the rotation, you can see they're pulling out of the growth stocks, they're pulling out of the tech stocks, and they're trying to find their way. And they think, well, if I go into value stocks, and banks again are value stocks, and even though they didn't break out today, you could see them in there trying to, they're dipping into the bank stocks hoping they would break out. But when you got a market, the bond market's closed. What you see today when the market opens tomorrow could be a whole different picture. So it's very dangerous to be in trading on a day like today when the bond market's closed, okay? What you think you're seeing today is not going to follow through tomorrow. So it's not really worth jumping in and trying, it's time to get in, man. I'm on my way. I'm not going to miss this. FOMOs do that all the time. And that's why 90% of the retail investor in the stock market loses money. Okay, let's move on from there. So I've been listening to the let's go back to, everyone's telling us how corporate earnings are terrific, right? Listen to this.
If you look at overall corporate earnings, they continue to be very strong.
It's not true.
What fascinated me about your comments, Ed, was how strong earnings have been.
Not true.
The earnings are there to keep the market going. And in a sense, we've had an earnings-led melt-up.
None of that's true. First of all, let's go back to gold. There's a reason why gold is soaring. It's the reason why gold today, okay, if you look at it, gold is up about 52% GLD, and the stock market's only up 6%. That's it, 6%. But the other thing that they're talking about earnings, they would ask them this question next time they say that to you. Well, if the earnings are so good, then why is it starting from April to October, the big institutions, the big hedge funds, the big insurance companies, especially the hedge funds, why did they get hit with a huge margin call? Because we keep being lied to as to, by the way, all these tariffs, they're not going to do a thing. You're not going to feel anything. You're not going to feel a thing about these tariffs. Really? Tariffs are slaughtering the earnings, so much so that 10 to 18%, those tariffs have been hitting hard companies and have taken those earnings down, where the big hedge funds got hit with a huge margin call. So that's when they started to unload all these AI tech stocks, because they knew they were going to unload them anyways. They had to raise money for a margin account, but they started to unload them. They didn't want to hold on to them because they knew the AI tech stocks, the prices are higher than their earnings. The valuations are stretched. So they started to dump the tech stocks, the AI tech stocks, and to raise capital for their margin call. But let's go back to the tariffs. When they say tariffs, let's see. I think where's the tariff one? Where's that one racked up? This one here, I think it is.
How do you make sure that these CEOs, that these companies don't, in fact, pass on the cost of tariffs to their consumers?
They cost Americans nothing. They made a great economy for us.
Now, did you hear what he said? Now, I'm a big supporter of Trump, okay? I don't know why he said that, because it's just not true. It's not true. Because if you look at the tariffs, they generated $151 billion. That's that 10 to 8%. 10 to 18% between April and October, $151 billion. That was collected. Think about that. Now, it's an indirect tax. Consumers pay an indirect tax through these higher prices. Coffee, beef, you know all the prices that are up there. So there is a big effect on earnings. And that is why the big hedge funds, their stocks, they got affected by these tariffs. Earnings went down, stock values went down, and they had big margin calls. And that's when they started to dump these tech stocks, which they're going to do anyways. To say there's no effect on the American people, then why is it President Trump, and I support Trump, I don't understand, why is he proposing a $2,000 tariff dividend? Remember COVID stimulus checks? Same thing. He's proposing a $2,000 tariff dividend check to every American, reminiscent of the stimulus checks during COVID. So if it's not affecting anyone, then why would we be doing another stimulus? That's the last thing we need now is a stimulus. Are you kidding? A handout? A stimulus? We don't need a stimulus now. They can't even get inflation back to the Fed's target of 2%. What are you, nuts? It feels like we're competing with Salami Madami. You remember Salami Madami, right? He was running around during his... when he was running for mayor, he said, look it, no problem, man. You don't have to send me donations, nothing. Just put me in office. We're fine. And then, oh, by the way, when I get in office, oh, you're going to get everything free. Just put your hand out. And you want to see all the stuff you're going to get free. Everything's going to be stimulus to fix New York's cost of living. It's going to be great. Where's Salami here? I have him.
There were a few months ago where I told supporters across the city to stop donating. And today I am asking them to start once again. And I am asking them to do so because of the fact that a transition that can meet the moment of preparing for January 1st is one that will require staff, will require research, it will require infrastructure. And those are things that we will have to provide. And I'm excited for the fact that it will be funded by the very people who brought us to this point, the working people who have been left behind by the politics of this city.
He's excited. The very people that put me in office are going to give me money, going to support me, because I don't even have a desk or a chair, because I'm a communist. And you're going to all pitch in. That's what we do as Marxists. You're all going to pitch in. Isn't that unbelievable? This guy is such a fraud. He really thinks the people who put him in office as mayor, half the people. The other half thinks he's nuts. This half, they're waiting with their hands out, get free food, free apartments, free everything, and he says and he's depending on them to send millions of dollars. Is he nuts? He's depending on people that they want everything free. Now he's asking them for money. Wait a minute. I voted for you. You said everything was free. Why are you asking me for money? I don't have any. And you pissed off all the billionaires. You dope. So you can't go to them because you're threatening that you're going to take their penthouse away and make it poor and make it low-income housing. God, this guy, I don't even think he's going to make it into office. You'll be outside on the sidewalk with tents, I think, during the winter, with heaters. Unbelievable. But let's get back to the stock market. I don't want to talk politics. I hate politics. But the last thing, again, please remember, these tariffs are serious. These tariffs are bad. And these tariffs, every time you hear these lies about earnings, they're all lies. In fact, the biggest lie is the S&P's doing terrific. No, it's not. Look this up yourself. There's only 10 out of the 500 S&P stocks that have earnings. Only 10. Look at this. You talk about the stock, see how great the stock market. Look at the market breadth. Look at the market breadth here. Look at this chart. This is unbelievable. This is the worst market breadth we had in 23 years. Are you kidding me? This is nuts. And people going crazy with AI. Look at all their money because of what? 30 seconds. Because of they can borrow money, right, on their margin debt. Look at this, where their money is. It's all in stocks. Look at this. It's all in stocks.
10, 9.
They have hardly no cash,
7,
debt, but it's all in stocks.
5,
Wow.
4,
More when we come back.
2.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When the stock market is volatile, how do you invest intelligently?
Hi, I'm Phil Grande at philsgang.com. There's no need for you to be panicking in a market that goes up 800 points one day, 700 points, then it goes down again. All you need is good advice, need good direction. You don't get that from your CNBC and the Fox Business and all these crazy shows. You don't. Here's what you get from them. Thank you, Jim Cramer. But this is something that this really bugs me. Listen to this.
Our responsibility begins and ends with our partners and our shareholders, and that's it.
What? Their responsibility is to their partners and shareholders and not to you? Check my site out, philsgang.com.
When the stock market is up one day and down the next, you need the experience of Phil Grande at philsgang.com.
What a difference it makes in your financial life. philsgang.com. It works.
Welcome back to the Phil's Gang Radio Show. Want to know more about Phil's Gang? Go to philsgang.com or give us a call at 877-600-4264. Now, here's Phil.
And people aren't doing their homework to say the stock market declines about tariffs. It's not, because the stocks have declined the most have absolutely nothing to do with tariffs.
How do you make sure that these CEOs, that these companies don't, in fact, pass on the cost of tariffs to their consumers?
They cost Americans nothing.
So, and again, I support Trump. I know him well. But this is insane to say that. Because as I said in the first segment, to say the tariffs don't hurt these companies, go look it up. Put in and find, why did hedge funds get hit so hard in April with margin calls? Because the tariffs slaughtered the earnings of the stocks they own. The earnings took those stocks down. Margin calls came. Huge. And then he dumped all your AI tech stocks because they were going to get rid of them anyways. Because everyone's disappointed with the returns they're getting. So anyway, this is just crazy. But let's move on to some other stuff that's important. We're talking about how the delinquencies, things are getting worse. Look at this. Look at this chart here. Auto loans, student loans, credit cards. Look how they're soaring. Look at student loans. Soaring. Now they got to pay these student loans. And for the first time, we're starting to see mortgages starting to get, delinquencies. Credit cards, big time. Okay? So these student loans are a killer. And the student loans is a terrible, terrible thing on young people. Terrible. That's why it's hurting the housing market. When they get out, all they're doing is working to pay back the student loan. They can't get it. They can't afford a starter house. All right, I'm running out of time, so I want to get back to what's going on with gold and the market and so forth. Okay, so as I said, think about gold for a moment. Most of the people don't get how important gold is. It's so misunderstood. Gold goes through stages. Now, as I told you, if you go back and look between 2006 and 2006 to 2008, leading up to that 2008 crash, gold was up 70% and the spiders were only up 19%. Can you imagine that? Today, our gold's up 52%, our spiders are up 6%, even worse. Now, gold goes through stages. Now, most people will tell you, and I even told you this, that when gold's going up, it's telling you something's wrong in the economy, something's wrong in the stock market. It gives you a warning. It doesn't give you don't have to worry about an imminent crash going to happen today. Because gold goes through stages. When gold outperforms stocks, don't sit there and think, oh my God, the whole market's going to, no. Gold has a status of a safe haven where you can go and protect your wealth. I mean, when everything gets bad, if I got gold, I can hold on to my wealth. It won't erode on me. And gold is not immune from dips. We just saw that. We had a dip. GDX had a 20% dip, but it came right back 11%. GLD, which follows the price of gold, that stock went down 10%. It's already got half back. The one nice thing about gold, if the stock market crashes, gold would go down, but it'll come right back. So don't panic if there is a crash. Now, it takes a while because gold, remember, goes through these phases. That everybody looks at gold, that's the one place I can be safe until it's no longer safe. But it takes quite a while for all of a sudden the market to collapse, okay? But it will. I mean, I'm not going to fool you. It's a very high probability, just like 2008, the market will crash. But gold, even going down, will come right back. Gold in every crash has done excellent. So you got to keep watching that gold, and you got to learn how to sell short. For God's sake, you got to learn how to sell short. These people on Wall Street make me nuts. Oh, don't worry. If the market crashes, we're going to give you in defensive stocks. We're going to get you in Clorox. We're going to get you in Clorox. We're going to get you in Procter & Gamble. Things people need. No, that's not how it works. When the stock market crashes, there's no place to hide. There is no place to hide. And this thing about diversify. That's insane. You diversify yourself right in the poorhouse. I'd rather put my stocks in one basket and watch the basket. Diversification will kill you, and not knowing how to sell short will kill you. 90% of the people lose money in the stock market. One, they have too many stocks. You shouldn't have any more than you should have the same 5-6 stocks all year. And then these spiders too. And once you learn how to sell short, you'll get out of that 90% of people in the last 50 years losing money. 90%. Insane. It's just totally insane. We have, so again, gold, as I said, is not immune from dips, but it will recover, just like what we saw just now, right? GDX went down 20, came right back. Half, boom. GLD went down 10%, bang, called back half. So these dips occur, remember, too, because of profit taking. And also people sell to get cash to cover their margins. But don't panic with gold. Gold's your best friend. But yes, gold does tell you, even though gold's role is a stabilizer in everybody's portfolio, that's why everybody owns gold, to help stabilize your portfolio. But you will get your crash. Now, here's what the FOMOs don't get. These are the tourist investors. These are speculators. These are gamblers. They don't want to learn anything. They just want to get a hot stock tip from somebody. And they went in yesterday and they started to buy like crazy. And guess what? Those stocks are down today. And I said that yesterday. When we saw the big tech stocks rallying, the first thing I said to my gang members, do not go after those stocks. Let them pull back. Switch to your line chart, let them pull back so you see it clearly, and then when your line goes up and makes a new high, then you're good to go. In other words, take, for example, yesterday we had, if you watched the Qs, how the Qs came down yesterday, and they chased the Qs. So what you do is you wait for the Qs to come back, switch to your line chart. This is what I teach my students, switch to your line chart. When it pulls back, then all you have to do, after you pull it back like this, it pulls back on its own, and it makes a little W. It looks like a W. And when that starts going back, and when that W is forming, the right-hand side of the W, and then it starts going up, and it takes out the high, the closest high. In this case here, the high would be 637. The stock's at 621. So you want to pull back to about, say 610, and then let it go up, having a nice buy signal, which is the W. There's only really 3 good buy signals. Call to actions called a W, a V, and then engulfing. And that's what we teach here. You don't have to know all these the Chinese names and one hung low and one left low, and we don't need any of that. I've been doing this business for 58 years. I'm telling you, you don't need all that. There's just 5 simple buy patterns. But going back to again, we're going to you're going to see the market collapse. You're going to see the market crash. There's no question about it, because this market has been going up on stock buybacks. This market's been going up on increased money supply. They've been pushing money into this market since 2009. QE. And it has to stop at some point. So stock prices are now higher than their earnings. Stock prices are now they're not aligned with valuations. Valuations are too stretched. Now, QE, remember, QT, he's going to go back to QT in December. Imagine this guy. Powell's going to go to QT. He should keep QT. He should keep draining out the money that's been pushed into this market and the economy with QE. Massive amount of increased money supply. 15 trillion. He hasn't got that out. He's got to get more of it out. But instead, he said, well, I'm going to turn around and I'm going to cut rates. Maybe not in December, but I'll start in January. Yeah, I got to see what the numbers are, but I'm going to cut rates. So he thinks by stopping QT, he's being smart. He's being stupid. We're not ready. We got to keep QT on. So what he's going to do, he says, well, I'm going to stop QT, and then I'm going to start doing some rate cuts. Well, wait a minute, that's not going to work. Because because the Fed, what they try to do is push down their rate. The Fed controls their own short-term bond rate. If he wants to move it from 4.2 to 1.1, he can do that today. But he doesn't control the long-term treasury. That's controlled by auction. So he thinks that if he takes the short term, he cuts that one, brings that down to where it was, down as low as he wants to, he'll bring the 10-year treasury yield back to where it was in 2022, about 3.1%. So in 2022, when we had inflation at 9%, all from this QE, all from this increased money supply, 2022 we had that 9%. He says, I better do something. I'm in the middle of an election. I'm going to start tightening now. I'm going to start taking all this money back, QT. And that will, when I do that, he says, I know what I can do. I'm going to finally get my rate down. I'm going to push it down as close as I can near zero. And then the long-term treasury rate, which is at 4.14 today, it will drop to 3.1. It's never going to happen. It's impossible. He can't get that down to 3.1. He'll never get that done. And as I told you the other day, the danger is that when he can't pull the long-term rate down that takes care of the automobiles. Remember, we've never had delinquencies in automobiles like we have now, or mortgages. Credit cards, historic credit cards, where people just making a minimum payment. We've never seen that before. So he thinks he can drive that 10-year treasury that takes care of your credit card, that takes care of your automobile, that takes care of your business loan, takes care of your house. He can move that down to 3.1 where it was in 2022 when he put in QT. And you can't do it. So then he's going to panic. He's going to do another QE. That's when your market crashes. That's when your market's going to crash, right there. So if I had a guess, I'm just guessing, because remember, nobody will be surprised. No professional, when they're trading, ever go, oh my God, that's a surprise, the market corrected. Oh my God, the market crashed, that's a surprise. No. Anybody who's a professional in business will tell you always know when the market's going to crash. Because if you do your homework, you got enough messages coming from your market, especially your bond market. The beautiful thing about the bond market, it tells you the direction that stocks are going to go. The market's forward-looking. It's forward-looking. So we got, the yields have been going up. If you look at the yields from, let's see, if you look at the yields, I thought I had them here. Hold on one second. If you look at the yields from 2008, I'll put them up here. Let's see if I can get them for you. Because this is really interesting. I looked them up today right before I came on the air. See if we can get the yields. Okay. If you look at the 10-year, look at the 10-year. Where's the 10-year? Hold on here. Really. Let's see. No.
30 seconds.
Oh, God, I wish I can get this for you quick enough here today. 10-year Treasury. I don't have it here. Darn it. Now, I'll do it tomorrow, but if you look at the 10-year Treasury, okay, and how it went up from 2006 to 2008, there's no way he's going to get this thing down. So we'll talk more about that tomorrow. Bring that information to you tomorrow. It's really interesting. So be careful. Join my gang. Learn how to sell short as well as go long. 10 days free.
Listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.